There's a bull market staring you right in the face, and all you got to do is buy and remain patient. Okay. Sounds cliche, but I'm going to go over these 4 reasons on the macro why this is the case and why this bull market rally in the stock market, even crypto, should continue. Maybe not the bond market, but I'm going to give you some reasons why. So we're going to dive into that after I finish the report. I'll do some Q&A. We are live, so TikTok, YouTube, we will do some Q&A. But first, let's get through this report. All right, let me pull it up here on the side. And part of the reason why I think people are so bearish, and I see a lot of people making videos, we're going to roll over, we're going to go back into the bear market, and there's reasons why that just isn't going to happen, right? It can happen, but the probability is much higher that we continue to grind up. So we will dive into that. So when investors lean one way, right, whether they're short, whether they're sitting in cash, or whether they're just not all in, right, that's leaning one way to the negative, expecting a crash. A lot of people expecting to crash for whatever reasons it is, interest rates, banks failure, whatever, and the market moves higher. And that's what we've been seeing. The market is still moving higher despite all these risks. And it's because the surprises are happening to the upside, right? The surprises are to the upside while they're positioned negative, where they're holding cash, they're not in, or they're shorting the market. And the reason why this psychology happens, in my view anyway, is because humans are wired to avoid pain, right? Psychological, emotional, physical. We prioritize focusing on the negative, okay? And that blinds us from opportunity. And I think that's kind of what's going on here in this rally, whether it's retail investors, and maybe you're not that person, or, fund managers. And that's because the pain of the past was so great that we deny, and yes, I'm reading part of my post here. My post is on here. We deny that anything good can actually happen. The pain was so bad, 2001, 2008, the pandemic, that we deny when something good is actually happening. We just don't prioritize it. We prioritize the negative and how we can get hit again. So like I said, I think we're in a bull market, and I think it's staring you right in the face. And we're going to go over why. We're going to go over why I think that's the case. And this is my macro report. So first things first, and we're going to get right into it. If you, like I said, we'll do some Q&A at the end. Wherever you go, I'm going to go through you guys' questions or your comments, address it. If you disagree with me, let me know, right? So number one, there's lots of cash on the sideline. There is a lot of cash on the sideline. And this is from Jurrien Timmer. He is the macro strategist from Fidelity Research, has a lot of good charts. And he basically points out that in general, this chart is basically the debt, the margin debt from the market, right? The margin debt in equities, in the equity market. And you can see down in the right-hand corner, basically margin debt is still negative, right? People are not levered up. That's what that shows you. Here in the gray and the blue, you're seeing the S&P 500 versus margin debt, and they pretty much correlate 1-to-1. But when that margin debt, we're seeing the we also saw the biggest this sell-off. We saw the biggest decline in margin debt in history, bigger than 2001, which means people delevered, right? The year over year down here in the purple, we delevered, extremely delevered, and now we're starting to bounce a little bit, but we're still in negative territory. This is just positioning. Positioning is still negative, even though there's a lot of bulls, markets going up. There's reasons for that, but big money or margin debt in general, people are not all in. They are not all in on this market. They're still waiting on the sideline in cash. Maybe it's not you, but we're looking from a probability standpoint. And so I think there's still a lot of people on the sideline for cash, and we get wave 2 FOMO coming up. Number 2, flows, right? There's a reason why the bond market is not getting flows, but the equity market still has negative flows. Here down on the right hand corner, this is equities in pink and bond flows in the yellow. Me personally, I think the negative bond flows, they probably remain negative for a while for specific reasons. The market is, the economy is starting to bottom out, and that'll play its way out. So if there is a crash in the economy, then those bond inflows will continue to accelerate. But for the most part, flows are still negative, right? Equity flows are still negative. Now, this last month, we did see equity flows increase. I think it was June. We saw the biggest increase in retail flows to mutual funds. So you do have some positivity there. But for the most part, we're still negative, right? From a macro stance, margin debt negative, equity flows negative. So people are still off sides. They're not all the way in. Okay, number two, wave two FOMO, the risks are starting to evaporate. And here's just a little bit of technical analysis, right? This is basically the trend highlighted in white, the Nasdaq. I'm focusing on the Nasdaq, and people don't like it; they hate it. Oh, there's only 25 stocks. There's only 7 stocks running the market. It can't happen. It can't continue. Is it unprecedented? Yes, it is. But there's always new things that happen in different regimes, right? The pandemic, we recovered in 2 months. So, hey, you stick with the probability most of the time, but markets change, and I think this is one of the fundamental changes that we are seeing because AI mostly, and these very strong companies in the Nasdaq technology are solving the issues in the economy. They're solving the issues that we're seeing when it comes to inflation, right? So number one, wave two FOMO above resistance, right? Go ahead and look at the QQQ Nasdaq resistance. S&P looks pretty much the same, and once we blow up above this level, I think we do get that wave two FOMO because it's more painful to sit there and watch things continue to rally than it is to just, catch a drawdown. So people are in pain. The pain trade is higher and it continues. I think the pain trade continues higher. So once we break out, there's going to be FOMO or just, okay, we got to get in, right? Number two, we're holding the momentum trend. So yes, we are elevated. We are overbought. We've been overbought. But we're holding the uptrend on that overbought signal. This is the daily chart. We are holding that uptrend, right? Maybe I should make this chart bigger if I need to. Let me see. No, I'll keep it right there. We'll keep it how it is. And actually, let me see how this looks. This looks a little better. This looks a little better. We'll keep right there. All right. So we're holding the trend, right? We're above the moving averages, by the way, too. That is a technical signal. Alone, is it everything? No, it isn't. But we're fanning out. We're moving higher. Number three, part on this chart, anyways, the RSI is reflecting a cooling phase, right? So we are not overbought on the daily chart. We're not overbought. As a matter of fact, we're starting to cool. And once you really start to gain momentum, you cool a little bit. You don't go all the way back down to the bottom of the RSI. Not to say it doesn't happen, but you can keep this up and continue to get on the oversold territory as long as you cool. So I think we're in a cooling phase, and we'll go over the reasons I see the catalyst to push us higher anyway. And if you are on TikTok, we are live on YouTube. And that's where you can see the charts. Okay. So number three, I got Bitcoin on here too, right? Because the NASDAQ is sort of in my view, the catalyst for, or the leader for the stock market in general. The big tech stocks, we already know that, right? Some people think that's a negative, but I think it's a positive because they solve issues in the economy. They solve they solve issues that help the economy to expand over time. So I have Bitcoin here because don't underestimate the ETF catalyst, right? People are, they're super bullish on the catalyst, the ETF, and then they hear all the negative news. It's not real. It's not going to stick. It's not going to get signed. But I don't think they understand how much money is going to flow into crypto, into Bitcoin, if that does happen, right? And okay, well, it's not going to happen now. You can be a negative Nancy all day, but this is going to happen. At some point, this will happen. BlackRock, Larry Fink, they're doing it for a reason. Do we have all the details? We never will. In investing, you never will have all the details. You got to side with the probability here. And I think the risks are in your favor, right? At this point, when it comes to crypto, when it comes to Bitcoin, and there's a lot of buying pressure, especially if the market breaks out. Bitcoin's going higher also. There's going to be a risk on period if we get that. We need more variables to be in our favor for sure. But either way, 32K is that level. If it gets above that level, we're going to see more FOMO into the Bitcoin narrative. We have a golden cross starting to form, the 50 right above the 100. This is on the daily chart, and it's the same thing. The RSI reflects the cooling phase for Bitcoin. Now it can consolidate sideways. That RSI cools, and then we get momentum right back into the market. But this is bigger than Bitcoin. This is not just about Bitcoin. I'm just showing the chart here. It's I think really when this ETF gets passed, we're really seeing the acceptance, right? The acceptance of tokenization everywhere. And we've heard this for years. Oh my God, it's not going to happen. Just stay tuned. Just stay tuned, right? There's more news to come. Okay, and here's the negative Nancy's. Oh my gosh, rates are rising. The dollar is unanchoring. Oh my gosh, rates are rising. That's been the theme here. And this is basically the the 10-year U.S. Treasury yield as a benchmark rate for the bond market. This is basically the cost of capital rising, and it is breaking out. Don't get me wrong. This was one of my risk off signals that the 10-year Treasury would be breaking out and going higher. So I'm like, wow, okay, risk off. I was wrong. I thought it would continue to decelerate, but there's a real reason why it's going higher. It's going higher because the economy is stronger than expected and the bond market is expecting higher inflation, although I don't think we actually get that, right? So yields are breaking out, but this time the US dollar is actually dumping. And the whole time that we've seen rates rise, the dollar rose with it, right? The dollar is a risk barometer. Risk off, the dollar goes higher because people are selling their assets. They want to hold dollars, right? It is the world reserve currency, whether you like it or not. And when rates rise, the dollar becomes more valuable because you can stake your dollar. You can get yield from your dollar at the money market funds for yield. So the dollar becomes more powerful. But what we're seeing is that yields are rising, and this time the dollar is actually, diverging. Now this could change, but in the short term, this is a signal I just haven't seen for a while. We haven't seen this. We haven't seen this actually happen. And my question is, okay, what's actually happening? We're seeing the dollar unanchor from the U.S. Treasury yield correlation. And I'm thinking here, equity market is still holding up after the yields rose. The equities are still holding up. They're consolidating, but they're still at the highs. They're not rolling over yet, right? So is liquidity leaving the Treasury market and into the, and leaving the dollar? Because that's what that is. As the yields go higher, that's money leaving bonds. As the dollar drops, that's money being reinvested somewhere. Okay. Into equities. Is it going into equities? Is it going into crypto? We don't know exactly, but it's a signal you want to pay attention to. I think it's important. Coming down a little further. Okay. Here's the next risk. Oh my gosh. Commercial real estate is at risk. Blah, blah, blah. Right. Now we know commercial real estate risk is more in the regional banks, not the big banks, because according to my research, according to my understanding, is that mostly regional banks hold the commercial real estate on their balance sheet. So that's why I have KRE up here, right? If regional banks roll over, will we see the Fed's balance sheet expand? That's really what we're looking at here. At the bottom, you can see this is KRE forming a head and shoulders. It's a bearish pattern. Patterns don't mean everything, but when you correlate it with the fact that regional banks might be, we're seeing money market funds continue to take deposits from these regional banks. So the stress on them continues. Rates are rising. The stress on their collateral continues. So we could get a rollover, right? We could get that rollover. Now, the last time, this is the Fed's balance sheet in purple and light purple, the last time that we did get, the regional banks really collapse, and that is basically it's not a loan, just, if the regional banks collapse, liquidity is coming in. No, not exactly. It just means there's more banking issues in the pipelines. So if we do, last time we got that, the Fed's balance sheet shot up 450 billion, right? 450 billion. So my question is, what happens if we roll over again? What happens if we get that head and shoulders play out and it breaks down? Is it a deeper issue? Is it signaling that there's more, there's more issues in the pipeline, especially with commercial real estate? And do we get the Fed's balance sheet move up? Do we get more liquidity injections? Well, that's what we've seen, right? Because they're not going to let the whole banking sector. What people don't get is the Fed is not going to let the U.S. economy collapse, because what they're doing is they're handing over the keys to economic growth over to China, over to another country. They don't want to do that. So they will keep growth higher before they allow the economy to collapse. And they'll just do yield curve control. Now, that is debatable. People don't believe it. Either way, bank term funding program, that is the liquidity. If regional banks roll over, then what I'm saying is we get more printing, BTFP, right? Bank term funding program, or buy the Fed pivot, as some people say, or buy the F and dip, right? Whatever you call it. Next. The next risk is really these interest rate risks that we have been looking at. Oh my gosh, higher rates, the balance sheet runoff. Now keep this in mind, okay? It's not unusual for equities to climb during QT when you get QE from the White House, right? And what this means is, or what we're looking at here is basically, when we had the Fed balance sheet run off in 2017, it was running off here. Here it is in purple. The Fed balance sheet was running off, right? Fed funds rate was going higher. They were tightening rates. They were in full on QT when it came to the monetary policy. But the Nasdaq rose 25%, right? With all this happening, because I think, it's pretty apparent that you had fiscal stimulus offsetting the QT. So it's not really QT because you're getting fiscal stimulus. This was the tax breaks from the 2017 tax breaks. They kind of got announced in September of 2017. They went in effect January of 2018. And as we got that, um, this fiscal stimulus was signed, the NASDAQ went higher and it continued higher after that because you get more fiscal stimulus. Now, alone, is this the only reason to be bullish? No, it isn't. I'm just saying, I'm just throwing out there, it's not unusual, right? It's not always the case that QT results in the market moving lower. And we've already seen the market roll off on QT. So I think there's a type of recovery or a catch-up trade as we end the tightening cycle, as we're near the end of the tightening cycle. And we just got to stay informed. Now, the biggest risk here, the largest risk that I do see that does worry me is, and I've said this all year, if you pay attention to my content, crude oil. The chart of crude oil does bother me, right? Energy inflation, that is the most volatile of all inflation. Everything else is due to roll over. Things are slowing. The economy is not speeding up, by the way. It is expanding because it's above, it's still positive, but it is slowing. So I heard somebody say earlier, oh, well, the economy is starting to expand, or the economy is growing. No, they said the economy is slowing, and that's a bad sign. Well, it's not, because inflation comes down. So as the economy does slow, month over month GDP growth, quarter over quarter GDP growth, that also means that the momentum of growth and inflation is falling. So shelter, core, all those things will cool over time. They are lagging. We all know that. But energy is very volatile. If you get some type of geopolitical risk, we could see energy, inflate back up to 85, 90, possibly 100. And I think that does cause the equity market to see some turbulence. And that, I think, is the biggest risk right now is energy. We got to get past 75. We haven't been able to do that. 83.50 is probably the last level to hold before real inflation starts to bounce, right? Until inflation starts to bounce higher and we get more risks. Now, keep in mind here, we've already saw, production cuts happen and oil dropped. Okay, another production cut happened or was announced and oil dropped. So it's not working. The production cuts are not working because growth is slowing in the manufacturing sector, which leads the demand for energy, and we could be rolling over. We talked about this last week, the virtualization, right, of the economy, and at the same time selling, who is it? Russia and Iran selling cheap oil, keeping those prices lower. Now, we don't know what's going to happen, so keep your mind on that 75. Just keep an eye on that 75 level. If it drops, if we can't get above it, we're going much lower. I think we go to the 60s, we go to the 50s, but if it gets above it, hey, it's a little risk off signal there. All right, number 3, recovering economy. We have pockets of strength and pockets of weakness, right? The manufacturing sector is still in recession. Don't get me wrong, we're still in recession. The services sector is starting to expand, though. Let me just get to the chart. Manufacturing activity, ISM PMI survey, we're still going lower, okay? We're still going lower, and this leads growth. This leads the business cycle, so we are going to continue to decelerate in growth. But there are some signals within the data. If we dive in a little deeper, we see we could be bottoming here maybe by the end of the summer. And a lot of this is coming from the fiscal policy, right? The fiscal policy that we just mentioned, the onshoring, we'll go over that, the onshoring of manufacturing inside the US, from the CHIPS Act and all those other stimulus bills from the federal government. So we see new orders are actually accelerating from May to June. Okay, they accelerated. Maybe it doesn't keep up, but we're tracking it. Supplier deliveries went up. Inventories drop, so demand is coming in, and prices pay drop, which is the key thing, because supply side inflation isn't happening, right? That's good. That means we can keep growing as long as inflation in its demand side and its supply side continues to decelerate. We can push growth up, right? The economy can keep expanding. We can keep the stimulus up. It's not inflationary unless we see the prices or the supply side go up. And I don't think we're going to see that. So when we switch to the services economy, right? Service activity, or the services PMI, blah, 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 it actually bounced. We thought it was going to roll over, but it bounced. It's at 53.9. It was at 50. And that tells me that services are hanging in there. The economy is being ran by services. When we dive deeper in the services economy or business activity in the services sector, what we see is that business activity itself is increasing. This was a big jump, 51.5 to 59. That was a big jump from May to June, right? So people are spending in the services sector, and businesses are making money. Employment also rose. So, hey, there's a demand for services, right? Prices fell. Great. No supply side inflation. That's a good deal there. So keep that in mind. Now let's roll over a little bit to the jobs report. This is a little bit of the jobs report. This is the rolling recession slash rolling expansion that we've been signaling for a while. A lot of people too. Ed Yardeni, smart dude, has a lot of good research. And we are seeing a recession in some sectors, but we're also seeing the expansion. I think this job report pretty much reflects that, because job openings are falling. That means job openings are being filled. And we see the labor force participation rate picking up and job openings fall. So people are taking the job, right? There's labor coming into the market. And I know people say, oh, well, I know this place, they're missing a supply here. Well, we're talking overall. We're looking at the macro. Job openings are falling, and that could be for various reasons, but I think it's because jobs are actually being filled now. Now, jobless claims are on the rise. So we do know that there is weakness in the economy, which is why we say, hey, there's a rolling recession happening still. It's not over yet. And but parts of the economy are starting to expand. So that kind of exemplifies that. Now, inflation. This is a sensitive part that the Fed needs to see progress on before the Fed actually fully, declares that the inflation dragon or the inflation problem is over. So we do see elevated wage pressure. This is the supply side of inflation, right? Employment cost index is still very elevated, but it's trending lower. So there's progress there, but it is, it's not moving higher, but it is still elevated. That's still an issue, right? Average hourly earnings are kind of sticky. So this is the supply side inflation that could be an issue, but it's still trending lower. Does it go higher? We'll keep our eyes on that. We'll keep our eyes on the signal. The moment it does drop or continue on its downward path, if AI comes in and solves productivity, then that's going to be very bullish for the macro. Manufacturing costs versus services. So we do see manufacturing cost of basically labor for employment is elevated. It is actually moving higher. So that's a risk. We got to keep that in mind. Does that continue? But also keep in mind, services are 70% of the economy, right? This is the biggest part of the US economy is services. And that inflation, that employment inflation from average hourly earnings year over year, by the way, is starting to decelerate. So you got a divergence there. Keep an eye on that. Now, what are we actually seeing if we break down the data a little further, what are we actually seeing? We're seeing out of these 12 categories for average hourly earnings, or just put it this way, wage inflation, out of those 12 categories, and May is red and June is blue. So you're seeing the acceleration month over month. Transportation had the biggest jump. Okay, but that's good. That's one category that inflated out of 12, right? That's one that really inflated. And on the flip side, mining dropped the most. Okay, so yes, we do have some wage inflation, but I think it's progress when 1 out of 12 categories are inflated while the rest are either neutral or dropping. Okay. Next job, and we got this jobs report, right? Everybody, oh, what do we do about this? How do we interpret the jobs report? This jobs report. We got non-farm payrolls still holding on. They're in positive territory. By the way, the Economist expected non-farm payrolls to be in negative territory right now, and a lot of analysts expect this to go lower. But with all that spending in the services sector, we see services expanding. Why would the non-farm payrolls decelerate, right? They're not going to decelerate unless we start to see the services data roll over, and we're just not seeing that. All right. Unemployment declines to 3.6. Wow. Robust labor market. Unemployment declined again. Oh, I don't believe the numbers. I don't believe the government. Well, what do you believe? Because when it's in your favor, in your thesis favor, all of a sudden you believe it. But if it's not, I don't believe the data, right? That's hilarious. Either way, just keep, you just got to take all the variables and add them together. It looks like the labor market is holding this economy together along with consumers. And that brings us to consumers. Consumer behavior is very optimistic in my view. In the last 3 to 5 months, consumers spent less than their incomes, right? And a lot of you, I guarantee, I would bet on it that you're spending less than your incomes, or you're at least not spending as much as you did in 2022, right? You're declining your spending. Maybe a couple months are different because parties or travel or whatever it is, but for the most part, you're not spending everything you have because you've heard this recession narrative take place, and fear does a job. That's why the Fed uses a lot of expectations, because it keeps people from spending if they think things are going to collapse, right? So point being, I think consumers are preparing for a recession. These are the last 3 to 5 months, or these months, their incomes were pretty steady and their spending decreased. We'll see if that continues. We'll keep track of the trend, as we do the report. Don't forget to sign up for the report. Link in the description. I'll have it there at some point. Consumers have shifted away from spending on goods. So we do have that goods deflation. And here we got retail sales in blue. Retail sales continue to decelerate. So we know, goods, things that are a little more durable, at least, are decelerating while we do have personal savings climb a little bit. Okay. So what that tells me is that the consumers are bracing for recession. Savings rates are up, they're not rolling over, and goods spending is down, right? Retail sales are down, except for autos. People have been spending a lot on autos. All right. Housing, real estate. I just have one chart here. Housing, real estate. We see construction spending, and this is due, I believe, to the actual what is it? The infrastructure bills, right? The infrastructure bill, the CHIPS Act, manufacturing, Inflation Reduction Act. That is fiscal stimulus coming in, liquidity, whatever you want to call it, to the economy. And yeah, residential is a little suppressed, but non-residential, okay, construction is skyrocketing, right? It is moving higher, and that is going to keep labor up. That's going to keep spending up, and so the economy doesn't roll over. We're in a rolling recession in some areas, but we're expanding in others. So that's construction spending. Now, last chart I have here, right, which I think the inflation dragon is near slayed. A lot of people will disagree. They will highly disagree. But why is the S&P and the NASDAQ up 20-something%? Because I think it is sniffing this out. I think it is sniffing out the inflation is making progress, and it is due to be, at the Fed's target in the second half of the year, especially if you believe we're heading to recession, right? Oh, I believe we're heading to recession. Things are going to fall apart, but inflation goes higher. It makes no sense. One or the other you get, right? The Goldilocks opportunity is growth slows down slowly, but it stays in positive territory while inflation decelerates. And this is arguable, right? But the point being, I think liquidity rises from here. So here, if you see October 22, when the market actually bottomed, was when liquidity bottomed, right? This is money growth from the four major central banks. So the US Fed, the PBOC from China, the European Central Bank, and the Central Bank of Japan, right? Or the Japanese Central Bank, whatever you call it, the BOJ. So liquidity is rising on a year-over-year basis. It is going up. It has been going up. But this is the May. This only measures up to May. So, we'll get next month. We'll see, or we'll see soon. I'll post a chart where we're headed. It's not going to go straight up. So, liquidity is bad. It's going lower. Well, global liquidity is picking up for the last 6 months. It's not going to go straight up. It's going to have a pullback, right? Just like a stock, it's going to have a pullback, and we're in that pullback phase. As we move higher, I expect markets to see that liquidity come in because they're much smarter than us and keep moving up into, I don't know when, but we're just consolidating. But overall, the trend, the momentum is higher. The momentum is up, and it's going to take a black swan to really pull this market down, in my view. Right. So next, the main catalysts we have are more progress on inflation. I think we get very low printed inflation coming up soon next week, and earnings growth. We'll have to find out, do earnings continue to beat expectations? All right. So that's sort of the wrap up. I will flip over to the Q&A. We'll do some Q&A both on here. And for that, I'll pull up some of these charts. Actually, no, that's not the chart I want to show. I'll pull up the actual market here. And if you want me to do some analysis on anything, let me know. This is the US dollar, man. If the US dollar, declining against yields, very bullish signal here. So yeah, let me jump into these chats. All right. So first we have here, I'll go back and forth from TikTok. From TikTok and YouTube. I'll start over here with YouTube, and we have Underground Economist. The bears need to lose money. Actually, let me pull it up like this. The bears need to lose money for nature to heal. Okay, fair enough. What up, Asan? What up, Football Legends? The hikes are priced in right now. The hike, yeah, the Fed hikes are priced in. The market's already pricing in the hikes. This is our second one. The market is pricing in the hikes, and the question is, and I'm going to go to TikTok after this. The question is, what does inflation do? Right? Even though we're expecting another hike, man, we just had 500 basis points of hikes. What is a quarter hike going to do when the macro is improving? So I don't even think the market thinks the hikes are that bad. Other people say the more they hike, the more heavy it becomes. But in my view, with the economy recovering, right, in the face of that, then I really think the hikes aren't that big of a deal. And I didn't think that was the case until I, evaluating the market. Volatility is coming down. Look on the screen up here. You have VIX volatility coming down, regardless of the hikes. It made a big move this past week, went lower. And then you have Nasdaq volatility also moving lower. You have bond volatility. This is the one I'm a little more worried about. We'll see if this continues to roll over. Maybe it doesn't. And then you have triple B spread. So corporate debt is still there's still risk in corporate debt. People are taking risk, in the corporate debt world. So anyways, those are triple B spreads. The hikes pricing, I think so. There are actually many more than 7 stocks that are doing very well in this entire year. Yeah, I know a lot of people say that Max P, and there's a lot more than 7 stocks. That's just silly. We can go through Dow, we can go through Monster Energy. There's a bunch of stocks, not just big tech, that have been carrying the market. The Dow is only 6.5% from the highs. IWM small caps are still in the bear market. S&P is not. NASDAQ is not. I think NASDAQ hits all-time highs for sure this year, possibly S&P. And we'll see how that plays out. All right. So that was that comment. Okay, I kind of missed that one there. It's almost curtain to see rejection on Bitcoin at the current level. Surely. It's almost curtain. Oh, it's almost certain. Okay, it's almost certain to see rejection on Bitcoin at the current level. Surely. So looking at Bitcoin really quick. Yeah. There's that 32,000 level is a big level. We'll see how it plays out. And I know in the short term, like if you're trading, it's rough, right? It is rough. But more specifically, I'm not even focused on that. I'm focused on the next 6 to 12 months, the next 18 months. This is all noise. It is going much higher because of the prospects of inflation falling, liquidity coming into the market, the China stimulus. Like there's a lot of liquidity. The liquidity cycle is at the bottom. And it's starting to turn back up. You need a black swan to really turn this off, right? To turn this off, or you need inflation to meaningfully tick up. And we have not seen inflation tick up. It's stickier in some areas, but I think those are mostly just lagged from shelter. Okay. Underground economist. In the long run, Bitcoin will go up forever versus everything else. So BTC is the forever trade. Fair enough. Fair enough. BTC goes up. Swallows. What is your reason for that? What is your reason that you think Bitcoin goes up forever? Just throw it in the comments. Asan, if Fed doesn't increase and pause, what would you expect? If the Fed doesn't increase and they pause, I think markets explode, right? And that will be more so from the actual CPI report coming up. And we have 2 days. We have CPI and then we have PPI the next day. And we're going to have to see some really good data for the Fed to pause. Maybe they don't pause, maybe they still hike, but I think if inflation drops meaningfully enough that they can still pause. I don't think it's off the table. And because the market's pricing in, it is pricing in a hike, man, if they pause because that inflation data is so good. And right now, I was hoping oil would fall off a cliff. We didn't get that. So oil is actually trying to make its way back up, see if it gets rejected. But yeah, we'll see. It's still uncertain. I don't see any clear path with rate hikes yet, but I don't think it's I don't think it's off the table that the Fed remains and holds this pause. They do manage expectations. If they do pause though, then I think the market, really gets some FOMO there. The market does look okay. Let me get to that next one. The market does look very wild and it's very hard to see which direction it'll go. Yeah, it's tough to see. And we can look at the technicals. I mean, if we just look at QQQ or SP, we could even look at SPX. I think we're just consolidating above that 4,200 level, 4,300 level. We're consolidating, getting ready to move up based off, risks are just starting to dissipate. And you got Janet Yellen going over to China. And I really think the governments are handling this. And typically when inflation does decelerate this fast from 9% to 6%, markets just go to all-time highs, right? You need a black swan. Oh my gosh, growth is going to decelerate from banking crisis. Well, we know the Fed steps in, right? We don't know that, but that's what they did last time. And I expect that to be the case because they're not going to let growth collapse. And going into an election year, expect the White House to keep on printing. For example, NVIDIA trading at 200 times earnings is very, very wild. Yes, Nvidia trading at 20 times earnings is wild, but in this regime, I don't even think anybody cares about earnings. They say it, but they still buy it. They still buy it because they don't want to miss out. Human psychology is probably one of the most important factors when it comes to price, not PEs. Um, Ps haven't really mattered for a long time for big tech companies because of what they're solving. So I don't really believe in Ps that much. I don't think I know there's a place for price to earnings for sure, but I like price to earnings on the overall market. I'd rather look at S&P PEs versus an individual tech stock. Now, if you do Ps again in tech stocks, you're comparing them to their competition. So that I think the way I look at it, I don't just look at a P. Oh, 22 is too high. Well, what industry are you in, right? And who's your competition? What is their P? What is their growth rate? What platform are you growing? What is your there's a lot of other questions than just PEs alone, and that's how I look at it. Anyway, all right, we need this consolidation. It moved up high, too fast, and that was kind of unhealthy. Yeah, for sure. It was a blow off top. It was a short squeeze in my view, and so we do need the consolidation. I like it. It's good. The more we consolidate above the breakout level, the more likely we are to continue higher or build a base at least. And if we stick up here higher for longer, it's really going to cause that FOMO. People, I believe, do come in. You see all that cash on the sideline. We talked about it, and I think that is the case. All right, so now I'm going to answer a little bit of questions here. They are just worried the Fed will be too aggressive due to good unemployment levels. Yes, Mike, I understand 100%. I think people are fearful that the employment numbers were too strong, but I think it's tricky. I think it's really tricky because they want unemployment to remain strong. They just don't want wage inflation to move higher. That's the risk, not employment. Employment and participation actually helps supply side inflation, right? So that's what I think they're really more worried about, the wage inflation than the actual employment strength at all, right? Than the employment strength in general. So that's my view. Maybe I'm wrong. We'll see. Would be buying heavy during any pullbacks, though. Yeah, a lot of people buying heavy during pullbacks. I think that is the case. Baba buyback and decreased regulation. Yellen improves relations. Parabolic. Yeah, Scoogie. Yeah. Yes, exactly. Janet Yellen over there in China. I think China was printing, right? They were printing, their currency dropped, the yen dropped a lot. And let me see if do I even know yen USD? What is the actual, I don't know I've never even looked at forex stuff. Yuan, is it yuan? No, it's yen. I don't know what it is, but I'm sure if we found the Chinese currency, actually, I could probably look it up on a different website. If we looked at the Chinese currency, I'm pretty sure it's falling, from what I've heard. And if it is falling, I expect the dollar to decline because I think what's happening is a lot of global growth struggled while the dollar went higher. It's the cost to trade. The dollar is a reflection of the cost to trade. It is a reflection of the cost to trade. So if the cost of trade is going up 20%, well, goodness sake, you're destroying the margins of global trade, right? So I think, this happened early in I don't remember exactly what year it was, but there was a deal in the 80s or the 70s where government officials came together and basically said, okay, we're going to make sure the dollar doesn't continue to strengthen to keep the global economy going. And I think that's what we're going to see is some type of policy or agreement with China. Janet Yellen's over there for a reason to get the dollar to decline further. That's might be why we saw yield. Like, this is another kind of echo why yields went higher, but the dollar did not in this past week. Yields went up, and usually the dollar goes up. It's interest rate risk, but that did not happen. So what's going on here? What is actually happening here? Why is the dollar declining? So keep your eye on it. Again, there's no pure curity. There's no clarity yet. The dollar's not beneath the level, but we saw that divergence, right? Something is changing in the market. Something is starting to change in the market. And I think it's all coming together. I think we are in that bull market, and you just got to stay patient. But for sure, yeah, going to the dollar. Let's see. Hey, nice to see you guys too. Appreciate you guys jumping on and supporting. Shout out to you guys who are, constant watchers, or constant viewers. I do it for you guys, man. To help you guys make better trade decisions or investment decisions for sure. We'll see rejection on Bitcoin at 31 to 32K. We're getting that rejection, but it is consolidating. I think the narrative is too strong. I think it's just too strong. And I even see Bitcoiners bearish on Bitcoin because possibly The bearish now Bitcoin does need a hold. So let me zoom in here. Bitcoin does need to hold obviously 30K, right? It needs to hold 30K, but I think there's a lot of support there, right? We're still in the uptrend. Maybe it drops and it keeps holding this uptrend. This is the uptrend we've been in for a while. So what inflation, we got to wait for inflation. Once inflation comes out Thursday, and the base effect should push it a lot lower. And if oil doesn't break out, I think we just keep moving up. I think this narrative for Bitcoin keeps going up. So technically, nothing alone is really predictive of price. But when you add all the macro together, yeah, it doesn't give you, oh, yes, buy, yes, sell, none of that. But when you add all the macro together, the macro turn is happening, right? The macro turn is happening. And one of the biggest things is the economy, right? AI is still underappreciated. People still don't understand AI and what it's doing and why investors are so bullish on AI. And they just don't get it because it's like the internet. Nobody understood the internet. That's why nobody bought Amazon early days. Google, they thought it was crazy. Like that's hype. It's all hype. And so I think that's what we're seeing also with AI and with crypto, is they just pass it over as all hype when literally other countries are creating stable coins. The U.S. government is creating stable coins, and they're literally talking about oracles and integrating and tokenizing certain things because it's faster, more efficient, XYZ. The renminbi, Max P. Japanese yuan is Chinese. Yen is Japanese and yuan is Chinese. Yeah, I was just looking for the I guess what would you do? Yen USD? Is that how you find it? Yen USD? I've never looked for it on here. Shame on me. Forex. Okay. Well, this is the yen. Okay, okay. Maybe I can find it. Um, let's go yuan USD. I'm pretty sure it's falling against the dollar. Ah, dang it. See, that's not it. US dollar, Chinese yuan. So the dollar's been this is USD to Chinese yuan. So yeah, this I guess to see what the yuan looks like against the dollar. Here, let me make this a little bigger. Right? So to understand what the yuan looks like versus the dollar, this is the we got to go in we got to inverse this chart. Whoa, what did they add here? No, I got to inverse this chart. How do I inverse this chart? Dang, they changed stuff up on me. Oh no, there it is. All right, so to inverse this is really what we're looking at when it comes to the yuan, right? So the Chinese yuan is declining pretty fast here. And I'm guessing this, let me see, January is when it kind of flipped over. This is because they've been printing a lot. This is one factor. They've been printing so much, and when you print, you devalue your currency, right? You're devaluing your currency against the other currencies, and the dollar is the strongest currency, so they're dropping, and that causes a lot of risk for their economy or their trade relations. So yeah, maybe we bottom here. We'll see how the Chinese yuan actually reacts. But and I'm not an expert on this, so I don't know exactly. I'm just kind of giving my 2 cents on what I kind of think is happening. Why the question is, why is Janet Yellen visiting China? You got to answer that question. Why is she visiting China all of a sudden? And I think we're going to kind of build our economies together going forward. I think we need to increase our trade tensions, or reduce our trade tensions and increase our relations there. And I think that's bullish for the market because it takes off a lot of risks. All right, going through these. All right, let me finish up. Whoa, whoa, whoa. What up? What up, you guys in the chat? All right, so if you're trying to show us graphs, all we see is your face. Yeah, jump over to YouTube. I mean, I'm sorry, I can't tell you to do that because TikTok is actually hurting people for saying that. So I have all the charts on YouTube, just so you know, Jasper. I can't even say. They say blink in the bio, blink in the blink in the bio for a reason. You guys already know. You probably know why I'm saying that. But there is a war. There is a war happening in these social media platforms, and they're trying to keep people from leaving. So that's why, Jasper, I am live on YouTube with the charts. Oh yeah, thanks. There you go. You already told them. All right, cool. What up, Yasan? What up? Do you think we are risk? You think we are risk off now, or do you think we go risk on when we don't hike? I would say there's a lot of there's a lot of risks, and man, we've been more risk on than I thought we'd be for the stock market. I don't know. It really depends on what you're looking at. I still think we're risk on overall, though. I think overall we're still in risk on territory. Look, if you invert the dollar, look at that wedge. That is a strong wedge. I guess you could call it a bearish wedge, but that looks super bullish, right? Which inversely, which is the reality, is it's very bearish. So when the dollar really does get below that 101 level, then I do think that it's going to be full on risk. So Yassine, go check out the newsletter, read the newsletter. I just went over it. I just went over the whole newsletter, the macro newsletter. You can rewatch the video on YouTube if you want to hear what I have to say about risk. I did talk about risk and risk on, risk off, risk on. Hi, do you think Tesla earnings will be good? Earnings date July. Well, their production numbers were very good, and they did increase prices a little bit on the Model Y, I believe. I think they're going to be good. I think Tesla's earnings, but don't take that as a trade because Tesla could blow out earnings and the price sells off. You just don't know. It could be poor and it goes up. I'm listening for Tesla earnings. I'm listening for guidance, right? What is the guidance and what is the projected margin growth? There's a lot of things to listen to. I think we'll actually be on UYT, YouTube. I don't even know if I can say that word on here now. They probably ban you. I'll probably be on YouTube streaming the actual earnings report and listening in onto that. If you guys want to hear that, let me know in the chat and I'll do that. We'll actually go over the Tesla earnings report. We'll see if they hike. Diet for the next 100 days: breakfast, strawberries, lunch, dinner. Okay, yeah. We're going to be doing the fitness live at 7 p.m. Eastern time on the fitness channel. Oh, is this guy just spamming the chat? I don't even know who you are, bro. Sorry, Santa Cruz Medicals. Not sure who you are. Maybe he thinks he's in the fitness chat. Not exactly. Yen, Japanese yen. Okay, 5 to 7 years ago. What do we got here? 5 to 7 years ago, all these fund managers rejected BTC and called it a scam. Now most of them are screaming Bitcoin as digital gold. Yeah, 100%. They know it's digital gold. Because I mean, digital gold's sort of a term that Bitcoiners use or crypto people use, but really gold has no use case anymore for a monetary network, right? All the central banks already own gold. Everybody mines it, so it goes higher. Where Bitcoin, the supply is set. It's set in course. It doesn't go up just because you allocate more resources to it. The supply dynamics are pretty are stable. They're the most, it's the most stable. It's never been hacked. Bitcoin has never been hacked. There's so many things for Bitcoin that people still don't get, but that's why the opportunity is here. That's why you have the opportunity, because nobody gets it. They still don't understand it. Just like they didn't get Amazon, Apple, Google, Facebook. Like that's why the opportunity is there, because most people don't get it. Sort of like I said earlier in the actual post, right? Let me try to get there or try to remember what is it that I was talking about. Oh, no. So earlier in the post, I guess I don't have it pulled up, but sort of what I wrote is, if you already or if you didn't hear it, I said when investors lean one way, they're short or they're sitting in cash. So you're short Bitcoin, you're sitting in cash, you're not all in, and you're expecting a crash. You're expecting Bitcoin to go lower, and the market moves up. It keeps going up 25K, 50K. I heard so many Bitcoiners, we're going to 12K. Didn't happen. They're probably still screaming it because they expect a recession to really happen. Now, given if there is a black swan event, they'll say, I told you so. Nobody is predicting. There is no economic data that predicts a black swan event. And if it already is possible for an average person to see it, trust me, the market's already priced it in. All right. Humans are just wired to avoid pain, psychological, emotional, and physical pain, or they're actually wired they're wired to avoid or dismiss something they don't understand. Also, a lot of people dismiss you if they don't understand you, or they dismiss a narrative because they don't get it, right? They haven't looked deep into it. So they prioritize the negativity. They're blind from the opportunity, blah, 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 whatever, right? So I still think, yeah, the bull market is staring everybody in the face, especially with crypto. The bull market is staring them in the face. And you just got to be patient. Cycles take a while, but when they move, they move. When they move, they move. Asan, the only use case for gold is in the semiconductor space and industries, limited amount though. Yeah, right. Still to conduct electricity. Bitcoin has a case, but it's losing it's a store value case to the Bitcoin narrative. Baby boomers, hey, they still like gold. There's a lot of gold bugs, but come on, who wants to own gold? You think millennials and the next generations are going to buy gold when they get their inheritance. They're not going to buy gold. They're going to buy stocks, or they're going to buy crypto. Bitcoin, JPY USD. Oh yeah, that's right. You know how that works. USD JPY, USD JPY. So this is Bitcoin versus the yuan. I'm sorry, this is the dollar versus yuan. See, the dollar's been strengthening against the yuan and the Chinese, the yuan and the Japanese yen. So I'm not a big forex guy, but I do understand that when the dollar drops, if this does reverse, that is going to stimulate global trade, and then you get more risk on back into the market, because when the dollar, everything's priced in dollars. So if the dollar drops as a denominator, well, the numerators are automatically going higher. If it is debasing currency, right? Not just because the dollar goes down or up, but if they debase, if we do get liquidity or the Fed's balance sheet start to pick up, we're going to see that. And we did see that earlier. We saw that. I mean, it was pretty clear. The banking crisis resulted in, right? If you guys weren't paying attention, let's go to the daily chart. If you weren't paying attention, the the banking crisis, the BTFP, right? The buy the Fed pivot, that was in March, right? And what happened to the dollar? They devalued the currency. The dollar dropped. It went back to that level. Now it's right back up, but it's making a lower high, right? And if you're familiar with price action, that's a signal of weakening dollar. And hey, if KRE rolls over, more Fed pivot there, more liquidity. So we'll see how that plays out. Bitcoin will be zero because government will put it down. Governments love, well, I guess you're not picking up with the news. Just to respond to that really quick, you think governments will put it down? The government during the pandemic actually had to use BlackRock, right, which is one of the biggest government entities. Who knows how and why? Call it a conspiracy, but they used BlackRock to buy U.S. Treasuries. So the government is very tied to BlackRock. It's the biggest asset manager in the world, right? And I'll have to do more research to understand. I'm not really interested to know all this super micro details. On the macro scale, BlackRock is very highly tied to the U.S. government, and the CEO is screaming for Bitcoin ETF. Come on, man. Why would they shut down Bitcoin? They own the Bitcoin. The governments are not going to work against Bitcoin. They want to own it. They want to make money off of Bitcoin, right? They don't just, we don't like this, because they're going to make, the best way to stay in power is to tax or to find a way to suck liquidity or suck cash or suck value out of the things that people create the most value from. So government's not going to get rid of it if they can make money off of it, is my case there. They're not going to get rid of it. Also, U.S. government will eventually come out with the crypto dollar. Well, but it's printed, right? It can't actually be a blockchain. Screen is on YouTube. Yeah, it might be, they'll come out with the digital dollar. They're already doing it, but I mean, that is a difficult topic. Maybe we'll go over into the future, because there's a lot of reasons to believe that the U.S. government's already using crypto to tokenize things. Oh yeah, and he talks about tokenization. The BlackRock CEO talks about tokenization. That's not Bitcoin there. That is Ethereum. We'll see in about 6 to 12 months. Everybody's going to be super bullish going into the halving, and it's not going to be because price alone. It's going to be because these narratives are starting to line up. So BTC is the new gold, the new digital gold. Yep. 1,000 years ago. Oh yeah. Well, let me get through these first. Best way is to have no competition to the dollar. Well, the Bitcoin that's kind of the thing is that Bitcoin doesn't compete with the US dollar. The US dollar replaced gold as a medium of exchange. I'd argue it never was a medium of exchange, right? I'd argue that gold was actually never a medium of exchange. Gold was the only time you really used gold to trade was if there was if you're buying an army, right? You didn't use gold in the streets to purchase small items, right? So this is this gold? This is gold, right? Yeah, this is gold. I don't know if this gold futures is very accurate. But dang, 2001 to 2000, this thing exploded. That was a big move for gold. Anyways, gold, the US dollar replaced gold because you can't create global commerce and trade with gold. It's too heavy. It's not portable, which means you can't just move it around. And it's not divisible, right? It's not portable. It's not divisible. And it is durable, though, so you use it as store value. So gold was never a good medium exchange. You can't create faster, cheaper transactions with gold. And so Bitcoin is not competing against the dollar as much, and people might say that, but it's really not. It's slow. It's meant to slowly to be secure and secure transactions, the big scale transactions. It's not made to go buy coffee really quick, right? Maybe XRP or something else, even though I'm not even for XRP or anything. But Bitcoin doesn't compete with the US dollar. It competes with store value. It competes with where people want to store value over time, where it is not debased by the government's printing. That's what it competes with. And that, asset has usually been gold. And the other assets you could say are stocks, certain stocks, right, that hold value, but not with the dollar. It doesn't compete exactly with the dollar. You can say the Lightning Network does to some degree. Stable coins compete with the dollar. Stable coins are what the bit or what the government is going after right now, because stable coins directly to compete with the dollar because it's cheaper, faster, instant settlement, and that's probably why I think the government is starting to build its own stable coin. So we'll see how that actually plays out. It already won, he said. Yep, already won. So BTC the new gold. Yep. Yeah, any more questions? Go check out the macro newsletter if you haven't already. This is what the whole stream is about, or you could just rewatch it. If you are on Tickety Tockety, help me out. You can subscribe to the YT, right? And help my subscriber count go up so I can reach 1,000. I'm trying to get there. Help pump me up, right? Can't do it without you guys, but yeah, if you think I bring you value, please help me out there and subscribe to that macro newsletter. It's free, and it's in the description. It's in the bio. Check that out. Do we have any more questions before we jump off here? I'll be back on Monday through Friday streaming at 10 a.m. Eastern time. Just got here. Recap. Damian Oliveras. Yeah, you can go subscribe to the macro newsletter. We just went through it a couple times, Damien, or you can rewatch the stream. It's on YouTube, right? So you could just rewatch it, put it on 1.5x so you can get through it quicker. Yeah, put it on 1.5x so you can listen to it a little quicker. Did that. Hey, I appreciate you guys though. Any more questions? Any more questions that I can answer? Any more difficult questions? Any more challenges? Anybody want to challenge my view on the markets, on the economy? Anybody want to, ask the difficult questions now? I still think the biggest risk is inflation reaccelerates due to oil prices. That's the biggest thing. I think everything else is kind of taken care of. All the volatility is starting to come down. We already went through this, right? We talked about it. Shout out to you guys though. Anyways, we will have live on fitness. What if the Bitcoin ETF is based with a synthetic asset on the base protocol or on XLM? Synthetic asset. The Bitcoin ETF. The Bitcoin ETF based on a synthetic asset. What, like synthetics? Well, I mean, it's BlackRock. BlackRock's doing the Bitcoin ETF, right? And ARK Invest. So that's what it's based off of. Sounds kind of like a what if question. I don't really know how to answer that, to be honest with you. But yeah, that's what we got down the pipeline. Anyways, yeah, I did cover everything. Appreciate you guys again, like I said. But it's custody. Yeah, it's custody on Coinbase. What do I think of Bank of America? I don't know. I think they're a good bank. They're straight. Bank of America does a lot of good research on crypto also. So if Bank of America is bullish on crypto, man, what are you missing, right? What are you missing? Hey, again, if you missed the stream, I have it live on YT, on YouTube. I have it live on there. Just don't want to see it so the algorithm doesn't crush me. I don't want to say it out loud. But anyways, getting back to it. Yeah. Hey, I'll be live, okay, Monday through Fridays at 10 a.m. Eastern time, going through the price action of the market for you traders and macro news, the stuff that comes out, trying to keep up with the markets. Here to deliver the best I can. All I ask is that you like and sub to the channel. And also check out my newsletter. I have a lot of newsletters, have a lot of content on there. And yeah, other than that, I'll catch you guys later. I appreciate you guys. We will stay strong. Oh yeah, that's what I was gonna say really quick for some of you guys that don't know already. TikTok Fitness Live at 7 p.m. Eastern time. So that'll be 3 p.m. my time. No, 4 p.m. my time. Go check it out if you want to hear. I think today we're talking about building muscle somewhere. I don't know what it is, but either way, go jump on that if you want to ask questions about fitness, health, routines, getting in shape, all that stuff, right? Go ask your questions on there, and we'll be live on the TikTok channel. Warren Buffett turns bullish on Bitcoin. Yeah, we might get that for sure. We might actually see that. Oh, EU time, bro. I don't even know EU time. I don't understand European time. All I know is where I'm at, it's 1:30 p.m. It's 1:30 p.m. All right, thanks for showing up.